Monk Who Trades, an MCX IPF initiative. You look really frail. What happened?
I recently got my blood test reports and it shows positive for hepatitis.
Monk always says be positive.
I recently got a tattoo done from an unauthorized parlor. The needles must have been infected.
The danger sign makes sense now.
I will teach those parlor guys a lesson.
Your safety is your responsibility. It's your duty to check for the required certifications and ensure that you are not dealing with quacks. Ensure that you deal with and through only SEBI-registered intermediaries. You may check their details on the Commodity Exchange website www.mcxindia.com and SEBI website www.sebi.gov.in.
All right. Thank you, Anita, for playing those two wonderful videos. I thoroughly enjoyed this MCX Monk series, of course. Very, very interesting. I want to welcome all the participants to this event on Metals Market Outlook. IMC, which is a 114-year-old organization, is one of the oldest chambers of commerce in the country. The IMC is a SEBI-recognized training institution for commodity derivatives. And IMC and MCX have joined hands. They joined hands 5 years ago, and we've been doing a series of events year after year on various commodities of interest, particularly to MCX, covering whether it is energy products or precious metals, base metals, select agriculture commodities, etc. So this is one in a series of events which we have been doing, and I'm sure we'll continue to do in future also. We have a wonderful panel this afternoon. I have Sandeep Daga, who's of course needs no introduction and who's going to talk primarily about base metals. We have Gnanashekar, who's going to give his outlook for the precious metals market. And we have, of course, Rashmi, the one and only Rashmi Nilani in the market, who will talk about trading MCX contracts and her views on the metals market, etc. So without much ado, let's straight away jump onto the topic. I have a short presentation to make, and please allow me a moment to share screen. Here it goes. All right. So IMC MCX webinar on metals market outlook. And we're talking about outlook till the end of the year. And possibly that outlook may even spill over to the initial part of 2022 also. But that's fine. So I just want to set the context. And again, let me re-emphasize that IMC is one of the oldest chambers of commerce, and we are a SEBI accredited training institution for commodity derivatives. We do a very large number of training programs for market participants. Okay, here goes the first slide. Okay, we are all living in what is called a VUCA world: volatility, uncertainty, complexity, and ambiguity. And all of us know how volatile, how uncertain this world has been, particularly in the last 2 years. There's commodity markets are always volatile. Commodity markets have always been complex to track and to trade. But in the last 2 years, things have actually become even more complex, or even more complicated, even more uncertain, primarily because of the pandemic, national lockdown, disruption to supply chain, and a whole lot of other consequential impact of the pandemic on the world markets, on the asset markets, including, of course, the commodity market. We are living through this world, what is called the VUCA world, and commodity markets are no exception. Commodity markets are also subject to all the uncertainties and complexities and ambiguities of the markets today. Now, the pandemic already, the markets were going through certain certain issues, including the trade war between the United States and China, for example, that also spawned a certain protectionist tendencies in the world. And that was in 2018, 2019. But come 2020 and till now, 2021, the pandemic and national lockdown and all that has further skewed the market. And several actions have been taken by various governments. We'll come to that very, very quickly. The market drivers, and there are at least half a dozen drivers to this market, major drivers to this market, are all constantly evolving, constantly morphing. The drivers are the same, but the dynamics of the drivers are changing constantly. And therefore, it's a big challenge to keep track of these market drivers and the way the market drivers are evolving. And therefore, because of this very complex and very dynamic situation, the risk perception today is substantially higher. I think Anita, mute everybody except the speaker. This heightens the market drivers, the dynamics of the market drivers, the rapid changes in the market drivers actually heightens the risk perception in the marketplace, and therefore managing risk is extraordinarily critical. And if we don't manage risk, businesses are going to businesses run a risk of losing out or losing money, losing opportunities. So businesses need to manage their price risk, and therefore to manage the price risk, you need to take informed decisions, informed trading decisions, and therefore to have an informed trading decision, you need to have a clear view of what is the emerging scenario, what is the outlook as far as each commodity is concerned, each commodity of interest to you. Therefore, you need to take an informed decision, for which you need to have a very informed and well-researched market outlook. And therefore, this is the purpose of this webinar today. Okay. Now, very quickly, what are the major global drivers of commodity market? This is a slide which I have shown in different parts of the country, different parts of the world, dozens of times, but this is such a key slide, and it keeps evolving from time to time, that it is important for all the market participants to remember. One, economic growth. The key driver of commodity markets is economic growth. There's a strong positive correlation between economic growth and commodity consumption. Particularly, there are certain commodities called growth commodities. As economic growth happens, commodity consumption also happens. For example, steel is a growth commodity. Copper is a growth commodity. Crude oil is a growth commodity, as an example. Therefore, it's important for all of us to track economic growth, the changes in the rate of growth, etc., of at least major economies. And there are leading indicators which tell us the nature of economic growth and the rate of change in the economic growth, etc. That's extremely important. The second driver is geopolitics. Geopolitics usually refers to a warlike situation or political instability, etc. But in the last 3 or 4 years, geopolitics has also included, for example, the trade war. For example, the US-China trade war, China-Australia trade war, etc. The trade wars are also distorting the global market, and therefore geopolitics includes trade war. And as a result of the trade war, there is a protectionist tendency amongst various nations. And for this protectionist tendencies further making the commodity market more complex and more volatile and more uncertain. Therefore, we need to track geopolitical developments. And when these geopolitical developments center around the MENA region, Middle East, North Africa region, which is the global hub for crude oil production, obviously it has an impact on crude oil prices right away. So tracking geopolitics is important, and interpreting the geopolitical development is important. Then we come to monetary policy. All of us know that if there is too much of liquidity in the economy, a part of the liquidity will certainly flow into various asset classes, including of course commodities. And when we have a tight monetary policy, fairly high rates of interest, that will actually control, contain, constrain, and rein in commodity price rise. At the moment, the world is facing a very, very liberal, what I call ultra accommodative monetary policy. Look at the United States, near zero interest rates, trillions of dollars printed and kind of floated in the economy. For what we have today is a very ultra liberal monetary policy, as a result of which the commodity markets have received a big boost, because a part of this money is moving into commodity investment, and therefore this monetary policy plays a key role in impacting commodity prices. Then we have currency. Of course, role of currency is a no-brainer. Everybody knows how a strong dollar caps the upside risk for commodity prices, and a weak dollar actually supports an upside the movement for commodities, etc. Similarly, a strong rupee makes our imports cheaper, makes our exports less competitive, whereas a weak dollar makes our import more expensive but makes our export more attractive, etc. So currency movements are also very, very important from a commodity market perspective. One more driver which has come into play over the last 3 or 4, 5 years, in fact, is technology. Technology is rapidly impacting commodity markets, and you'll be surprised what has technology got to do with commodity market. Yes, for example, we are talking about energy transition. For example, we are talking about electric vehicles. Electric vehicles obviously is a new technology. And for electric vehicles are highly metals intensive. As electric vehicles gather pace in the marketplace, although their share at the moment is less than 3% in the world, but they're going to rapidly increase their market share over the next 7-8 years. By 2030, the automobile landscape will be very different from what it is today. That's going to give a big boost to certain metals like copper and aluminium, etc. But technology is now beginning to impact the commodity market. Weather, of course, is very important. All of us know weather impacts agricultural commodities in particular, and all of us know how, for example, last year La Nina in South America has played havoc with various crops. And last but not the least is funds. The role of hedge funds, speculative funds, and pension funds, etc. They take a view. In fact, all these funds take a view of all the 6 market drivers, and then they invest, whether to go long or short or whatever. They decide their investment strategy based on the 6 previous market drivers. Therefore, it is important for all the market participants to track these market drivers. Next, now let's see how because we are discussing metals today, both precious metals and base metals. Let's see how the metals market moved in the last 3 years. I've just taken the August average price, say for last 3 years, August 2019, August 2020, and August 2021. Look at gold, for example. The kind of pendulum movement that gold has seen is extraordinary. I remember August 2020, if I remember correctly, gold actually crossed $2,000 a troy ounce. But the 1975, of course, is average monthly average price. I think end of the month price, if I remember correctly. Therefore, from 1530 in 1 year, it went to 1975, and then look where it is. It is now around $1,800, $1,820 an ounce. Okay, that's the kind of swing that we have seen. Same with silver. Silver, of course, moves almost in tandem with gold prices. Although silver is also not only a precious metals, but also in industrial metals. And industrial demand does impact the silver market and silver prices. Silver prices have also moved like a pendulum. Look at copper, extraordinary bull run, put it that way, in the copper market. Starting from July or August 2020, when China opened up and started to normalize its economic activities and started to import larger and larger quantities, I think there has been no looking back for copper, and currently trading just around $9,300 a ton from about $5,700 2 years ago and 6,600 last year. Aluminium has also had a reasonably good run in the last 1 year, although the kind of stellar movement that copper has seen, aluminium has not seen, but aluminium has also performed quite well. We can see how nickel prices have also moved back and forth. Zinc prices have moved back. Zinc prices have actually substantially improved in the last 2 years, with production of galvanized steel improving, consumption of galvanized steel improving, demand for zinc is also substantially improved. And then therefore, the point is, this is the way precious metals and base metals markets have moved in the last 3 years, and that should tell us that we are really living in a VUCA world, volatile, uncertain, complex, and quite ambiguous. Okay. Now, quo vadis, it's a Latin expression. Where are we going from here? Where are the metals market going from here? My own reading of the market situation is very, very clear. The sentiment across the world is certainly improving. The kind of negative sentiment that we had 1 year ago, say early to mid 2020, was very despondent. And now, of course, with ongoing vaccination around the world, more and more people getting vaccinated, the sentiment is turning gradually from one of despondency to one of optimism. And China has, of course, played a significant role in this gradual shift from despondency to optimism. Yet, in spite of this ongoing vaccination and improvement in the sentiment, the optimism is rather cautious. It's not unbridled optimism. It's a very cautious optimism as supply risks continue to persist. We're all talking about Delta variant, etc. Those are less clear risk. It is a risk, but the clarity about the risk is not available as yet, and therefore we need to take the risk on board. Recognize that risks are abound still in the marketplace. China is, of course, from as I said, from a year ago, July, August, September last year, China has had excellent revival of its economic activities. There was a stimulus package given by the Chinese government. Their voracious appetite for consumption, and all that, when you month on month to track their import data, massive increase in their import numbers, whether it is energy products or whether it is base metals or agriculture commodities or whatever. China's massive appetite, but that appetite, my sense is, now slowly beginning to wane. It's slowly beginning to reduce. And then let us look at the liquidity driven commodity boom. As we said earlier, the huge amount of liquidity in the global economy, particularly in the United States, of course in Europe and other major economies, that excess liquidity is what has driven commodity markets higher and higher. Now is a sense all of us get, particularly from the US Federal Reserve, that this ultra accommodative monetary policy will start to normalize. From when, at what point of time is very, very difficult to say. My own sense is it will start to begin to normalize, and the process will, of course, continue the whole of 2022, but a beginning will probably be made by the end of the year. Is my sense that I'm getting at the moment, and therefore the big question, uncertainty is when will when will uh, uh, when will the tapering start, and when would the US Fed start to raise interest rate? Raising interest rate is of course a little it's a little away, probably in the second half of 2022, but tapering will surely start. My sense is by the end of the year. Now, will all this is obviously going to impact not just a base metal but also precious metal, because gold is gold's demand basically is a safe haven demand, and if and of course investment demand. But if the economies are doing well, if stock markets are doing well, if the dollar is going to strengthen, and the safe haven status of gold will probably be under question for the time being. Therefore, what is going to be the impact of all this on gold and silver prices? I think these are questions which we need to debate, which we will discuss today. Now, my sense is, as I said earlier, China's activity is very clearly slowing. They had given a stimulus package last year, but the effect of that policy stimulus is beginning to fade, and there is enough data to prove that the effect of the stimulus is beginning to fade. Look at their industrial growth in July. Chinese industrial growth fell to 6.4% from 8.3% in June. It's a very clear signal. Second, the commodity intensive property sector in investment is also cooling in China. China is slowly, as we know, moving away from investment-led growth to consumption-led growth. But yet there will be investment in fixed asset, but the rate of increase in that investment is obviously declining. For that property sector, investment is certainly cooling because the borrowing norms have been made tighter and tighter by the People's Bank of China. For my expectation is that industrial metals will surely soften in the months ahead. We are not discussing price outlook in this event. My request to my co-panelists is let us not discuss price outlook, but we can give a price direction, what is likely to happen. My sense is industrial metals are likely to soften in the months ahead, certainly till the end of the year. Coming very specifically to copper and aluminium, my own sense is amongst various base metals, my view is copper looks the most vulnerable. It looks the most vulnerable primarily because of slowing infrastructure activity, that also specifically in China. And the slowing infrastructure activity will mean slightly lower consumption of copper. And copper has been in a state of deficit last 2 years from last year. And therefore that state of deficit will slowly give way to a small surplus in 2022. And obviously that will have an impact on prices. But aluminium, in my view, again, is likely to stay quite firm. The Chinese output is quite muted because of power rationing, and therefore China, as we all know, is a big producer and consumer of aluminium, and aluminium is a highly energy intensive industry. And when you look at all this, I also expect the investor sentiment will also certainly be tempered. When you look at small slowdown in China and its impact on the metal market, the investor sentiment also will be tempered because of the Chinese factor. There will be supply risk. We don't know what can happen potentially in South America, for example, from a supply perspective. But the world has learned a lot of lessons in the last 1 or 1.5 years about managing the pandemic, managing the COVID crisis, and therefore supply risks will persist, but my sense is they are a lot more manageable than they were a year ago. And this is probably my last slide. The gold and silver, and my sense is gold is certainly facing headwinds. Although the statement by US Fed, the chair, a couple of days ago has given some ray of hope that the ultra accommodative policy, monetary policy will continue for some more time. But I expect the dollar to strengthen. Dollar is weakened. I expect it to gradually, it will not stay weak longer. The US yields also will start rising, because the US economy is definitely beginning to improve, notwithstanding the risk from Delta variant, etc. The Fed is talking about tapering. Equity markets are high, and the benefit of inflation, gold is not receiving the kind of benefit that usually gets from inflationary tendency. And finally, physical demand is still quite subdued, particularly in a large importing, consuming nation like India, and of course China also. The risk from COVID-19 Delta variant may provide some support to gold, obviously, because that's a risk and that's an uncertainty. And I expect gold to trade in a range over the next, we are what, in August, September, October, November, December, over the next 4 months. And with this, I just want to thank all the participants. I have a disclaimer to make. I usually make. I am not a trader. I don't trade neither in the physical market nor in the futures market. I'm a student of the market, and occasionally I'm also a teacher of the market. With this, let me say good luck and God bless. Thank you very much. And I now will stop sharing screen and invite Sandeep to share his thoughts. Sandeep, the floor is yours.
Yeah, thank you. Thank you so much, sir. And thank you for setting the floor. I think you've set the backdrop for what I'm going to talk about. Let me share the screen straight away. Right. I hope it's visible, right?
Yes.
Okay. All right. Thank you. So I'm going to cover base metals, and very briefly, base metals, one word that can really describe base metals at the moment is hot, really hot. Everyone's talking about it. Every newspaper covers it. Every news channel covers it. And a lot of information about the headlines that the base metals are making, made by aluminum or copper. Investors have conviction in India or overseas. Investors have been investing in the metal for almost 1.5 years now. So now that Mr. Chandrasekhar has set the backdrop, I would not like to cover the headlines as such, which most of you may be already aware of. I would rather go into the themes that are driving the market, so that we understand the background story that's really driving it, and we take it from there. So Chandrasekhar touched upon this. China versus the rest of the world. In the last almost 2 decades, we have seen that metals is equal to China, because China is nearly half of the metals world, the largest producer, consumer. And whatever happens in China drives metal prices. The interest rates, to the infrastructure spending, to the stimulus, to any policy change they do, their import arbitrage with the rest of the world, their export, their trade war, everything affects metal prices. But in the last 6 months or so, we have seen that the world has moved on from China, and they're looking somewhere else. The Goldman Sachs in its report has said that it's no more about China. So while they claim that it's going to be a super cycle, they say that it's not going to be driven by China. So what is it that's driving the metals, and which is ignoring China? We're going to cover that in a slide. There can be 2 stories in metals. The one can be supply side and that can be demand side. both can drive prices. The demand side stories are more sustainable. The prices stay high for very long time. Supply side stories are temporary. As the problems are sorted over periods, the prices come back lower once again. So we will explore whether it's about supply or about demand. We are in the period of social media, and people are judged by the photographs they post on their Instagram and Facebook. And believe me when I say this, the same applies for metals. The headlines that's created for them can be sometimes misleading, sometimes can be away from reality. Yes, those who create the headlines win the day, maybe the week, maybe the month, but in the longer term, it's the reality that counts. So we'll touch upon some examples of how narratives are getting different from the reality. Then we'll also touch upon the bulls versus the bears as to how they are doing in the metals market, how they are positioned, and how do we see them behaving in the months to come. So the first thing first, let's look at the rest of the world versus China. In this chart, I have taken the PMI manufacturing index of China and that of US and Germany. The gray one, the flattish line, is China. Now, this is a PMI that calculated by reducing 50 out of it. So if it is above the zero line, that means there's an expansion. And the farther away from the zero line on the top chart, on the top side of the chart, it says that the economies are doing better. So higher than line goes, the economies are doing better. So as you can see, in the month of March, April, May 2020, at the beginning of the chart, it was China which was doing better because they came up out of the crisis very quickly. And there was a contraction in US and German economy. As you can see, the reading was in the negative direction. But as the months passed, China slowly and gradually started to slow down. And the last reading that came out today for August was 50.2. That means they're just barely at the zero line in terms of the industrial expansion. But then you look at the US and the German PMI, they're doing far, far better. They are nearly 55 to 60 and maybe above 60. So that makes one think as to, is the world shifting? Is the center of gravity shifting from China to the Western world? So US PMI rose after $5 trillion of the stimulus was spent between the last summer to the March 2021. Germany, which is an export-oriented economy, got orders from US, from China. So US was in the last 6 to 9 months, it was the US which created the demand and everybody grabbed it. Chinese exports went to the record high, and to a great extent, last 6 months of growth in China was driven by the demand that US created and not that much by the demand that the economy was creating on its own. So that makes one think whether it's about the rest of the world and not about China. Should we ignore China? Many people think so. I side with Mr. Chandrasekhar saying that China is still too big. It's the gorilla in the town to really ignore. To just give the perspective of this, China consumes nearly 60% of the metals, not 50% anymore. It's about 60% of the metal of the world. Every year, whatever the incremental growth in metal demand that comes in, nearly 80% of it still comes from China. We are talking about electric vehicles creating new demand, green energy, the green demand for metals. But that could be driven by the Western world and the EVs taking over the whole world over the next decade. But at the moment, EV is, if I can give you an example for copper, is just 1 million ton of consumption. As EVs and all the solar power and everything altogether, the green energy, that consumes nearly 1 million ton of copper as compared to 25 million ton of total consumption. It's very small. Giving you one more perspective, Biden government has recently given a budget forecast for next 10 years of growth in US. And the number they're forecasting is an upgrade from the 2% forecast that was given earlier. They have now moved to 2.2%. That gives you a perspective. Howsoever noisy the US economy can become, it's a mature economy. And their sustainable growth rate can be somewhere around 2%, while China is still growing at 5%. So whatever happened in the last 15 months may not be a trend. COVID has disrupted a lot of economic trends, and thereby ignoring China and what's happening in China could be wrong when it comes to metals. Now let's look at the supply side issues. Now, as we discussed, the demand side stories and the supply side stories both are dynamically changing in base metals. If I look at the base metals demand in 2021 as compared to that in 2019, I can tell you the demand is not far better than 2019. In some cases it's better, in some cases it's not. But overall, if we put all the base metals together, we are quite at par with 2019 in most metals. But yet, the prices are far higher than what it was in 2019. And why is that? This is because the supply side issues are getting back to work. Now, I'm not sure as to how many of you have gone beyond the headlines of what's happening in the shipping world. Obviously, we know there's a congestion, and this congestion is getting back to work. So every time it comes to resolving, some other issue comes up. The Suez Canal issue came up, and there was a 3 weeks back the closure of one terminal, the Ningbo port, which is the third largest port in China. So all of these COVID-related disruptions are continuously coming, because of which the shipping freight is about 3 to 5 times higher than what it was in 2019. Now, a question that people ask, and I saw this interview from the CEO of Maersk, that is the largest shipping company in the world, is as to what has happened to the shipping volume as compared to 2019. Their answer is that the shipping volume has gone up by 2 to 3% as compared to 2019. Yet, shipping freight is far higher. And the reason for that is that the demand is actually, most of the demand is coming from US. So all the ships are moving from Asia to US or China to US. And so because of this one-way movement, there's a congestion of ships, and that's creating the freight far, far higher. Those people are exporting products out of India or importing metals into India. They would know as to how serious the problem is. I'll tell you one example. In Long Beach, which is a major port in US, there are 44 ships waiting on average over the last 1 month to get into cleared. So while it takes nearly a month for ships to reach from China to US, the ships wait there for several days before getting anchored and cleared. The similar stories in many other countries. South America, the port is full of ores. They cannot ship it out because there is no material, there is no ship available. And I can tell you that commodities are bulky. They cannot be airlifted. So they have to move by ship, while the smaller things can move by air. So that has created a big shipping problem. And because of which, this is what I tell my clients, that we see more metal and ores on the sea than on the ground these days. Now, the third thing that is disrupting supplies is that COVID continues to play havoc. So in 2020, we had these South American mines really struggling, and they had a lot of production losses, especially in Peru, which is very large, which has very large mines of copper and zinc and silver. But then this year we had disruptions in Malaysia and Indonesia. So Indonesia has very large capacities of nickel pig iron. Over the last 5 to 7 years, China has moved on NPI capacity, which we call the nickel pig iron capacity, smelting capacity, to Indonesia in order to reduce pollution in China. But now with Indonesia struggling with COVID, nickel is not going back to China, and that's creating a lot of shortages, and that's the reason nickel inventory in China is very low. The same happening for tin. Malaysian smelting company, which is the largest smelter of the world, is under force majeure for more than a month because of national lockdown in Malaysia. the metal cannot come out. There is shortage of tin almost in every part of the world. So all these COVID disruptions are creating a lot of issues. But the most amongst them, I would say, supply side issue is the Chinese Green Energy Initiative. So China has created a map or a plan for reducing carbon emission. By 2060, it wants to be completely a green country, and because of which it's taken a lot of initiative in order to achieve that target. Now, because of this, the two things that's happening. The first thing is that it is reducing the output of the small and polluting smelters. So the output is coming down there for sure, and they have a plan to gradually curb the output, and that's a very welcome sign. But that was still not that disruptive of supply because it was planned to happen that way. But what happened from June 2021 onwards is something which was not planned. So Mr. Chandrasekhar talked about weather and the impact of weather on agricultural commodities. I would like to highlight the impact of weather on the demand supply of metals. In fact, China had a worst drought. And Yunnan is a province where a lot of large smelters of aluminium and zinc and copper are there, where electricity is produced primarily from hydro sources, from water. So as the drought came in, the water supply came down, the electricity supply came down, because of which there was a shortage of electricity and the output of every metal came down. And then this problem spread out in many other parts of the country. So you can take Guangxi province, you can take Xinjiang province, you can take many of these provinces where these problems are spreading. And because of which, this is the chart I wanted to show, that this is the combined output of 10 non-ferrous metals in China. As you can see, the production growth was amazing. As the prices were going up, Chinese smelters were lapping up by producing more. Until December 2020, it was doing amazingly well. And then you can see January, February, obviously a lull month for them because of the lunar holidays. But after that, the production has not picked pace because of in the summer months, the electricity is being rationed, and because of which every smelter, may it be government owned, may it be private owned, have to give up some of the output. And this is showing that here. So this is one big reason why metals are here. And let me repeat, the demand is not extraordinary, but what is happening to supplies repeatedly, one after the other, is really extraordinary. Let's look at narrative versus reality. Now, there are many stories in the market about certain businesses doing very good, metal business doing good. I would request you to look beyond what you are reading in the headline. For any metal business, the bottlenecks are really great. May it be based in China, or may it be based in US, or may it be based in India. There's a shortage of labor, there's shortage of input. So if I can give you an example, in US, it's no more only about the shipping shortages or the shipping bottleneck. It's also about non-availability of drivers for trucks. There's so much of shortage of drivers, truck drivers in the US, that they are getting, many of them from South Africa. There is so much of labor shortage in UK that the automotive output, because of the labor shortage and chip shortage, has gone down to the lowest level since 1950. So you may call it a fantastic time because there's so much of shortage that means prices should go up. But from the business perspective, the volumes are going down, and the backlogs are going up, and they cannot turn around from raw material to finished goods as quickly as they wanted. So this could be good time from prices point of view, but from business point of view, it's not that good time. So I would suggest that you should look at it from the cost and the margin point of view. And as the metal prices go up, it's just one company or one chain, one link in the chain which benefits out of it, which is the mining company, but all others in the chain really suffer out of it. So This this narrative about high prices because of shortages looks unsustainable from their point of view. The other narrative that comes out is that there's a deficit of metal all over the world, and the reality is that it basically, for many metals, I'm not saying all of them, but many metals, there is a surplus in Asia and there's a deficit in the US. And again, it's all because of these logistical problems. The US metal premiums are at multi-year highs. So if you're looking at US stories, if you're reading US newspapers, you're listening to the news report that's coming out of US, they would be ultra bullish because the metal is not reaching them. And the metal premiums are at record high. But if you go to China, if you go to Thailand, if you go to Indonesia and Malaysia, there's so much of metal sitting there, which cannot move out, maybe because of COVID, maybe because of port closures, maybe because of there are no containers, or maybe because people want to export out, the sea freight is so high that the US prices are still not lucrative enough for them to really move it. So, I mean, if you look at the global picture, the metal is quite balanced. Metal demand supply is quite balanced, quite available, but there are regional disparities. Asia is in surplus, US is in deficit. And then obviously there's a cheap money, and when there's a cheap money, they always make noise. They make any story far, far bigger, and that's really happening. And you know, these days, having a few $1 billion is very easy. The interest rate is 0 to 1%, and with that, you can corner inventories and you can, you know, make the stories far bigger. And these kind of games are being played in many markets, including in LME. So if I can just give you an example, lead is a classic example, and I must give you this example. So the automotive demand all over the world over the last 4 months have been continuously declining. Chip shortage, labor shortage, all of those issues. Not only in US, China, India, everywhere, the global automotive production has been slowing down. And lead is a metal which is principally used in the batteries. So the lead prices should have been coming down, but they are not coming down. Why? Because there's just 40,000 tons of metal sitting in LME warehouse. So where has that metal gone? It's gone to US, because those warehouses which close to US and Europe, those inventories have been delivered to the US consumers. What is happening in Asia? In China, the lead inventories are at record high levels, and it's rising every week. There's so much of metal inventory available, but they're not able to ship it out. So it's the classic world. And then looking at this story, somebody has cornered away all the surplus around the Western world into one hand and making the shortage look far bigger than what it is. And the backwardation, what we call the gap between cash to 3 months, that went to almost $250 2 weeks back, which is nearly 13% of price. So all of these are kind of historic times and looking very unsustainable. Let's come to the last driver of bulls and bears. And as you can see, the speculative ratio position of longs versus the shorts, the bulls versus the bears. In copper, I've not updated this chart. The chart was taken 2 weeks back. The latest data shows that in copper, the long versus short ratio is almost 1.3, which used to be about 3 to 4, has come down. That means long and short are almost equalizing. And since February, the longs have been continuously exiting copper. In case of tin, the longs are the highest and the shorts are just not there in a way, because there is a physical market shortage because of Malaysian COVID problem. And this problem is here to persist. So it's a physical market story in tin for sure. Similarly, nickel and aluminium, there has been a positive story because of declining stocks in China as well as in US, and that's helping out. In nickel, the story looks temporary because of the Indonesian lockdown, and as soon as the lockdown is over, I think this will start to ease. In aluminium, again, the story looks temporary because China has massive capacity. They just do not have power to run it, and the power is not there because of the summer months. And the summer months will get over by mid of September, and then the electricity supply should be Okay, so by October, November, December, I would expect a very quick run up in aluminum output in China. So let's look ahead, just that last few slides on copper. In copper, we are seeing in very short term, just talking about 3 months point of view, we are seeing a physical shortage reappearing in August in China, but this looks temporary and this would ease over time as the Chinese output starts to recover again with electricity problems for resolving. But the TCRC, which is a discount factor which suggests about how much is the supply of ores, that is showing that the mining supplies are rising. And I must tell you this, that even the biggest bull of copper, which is Goldman Sachs, even they expect the mining output to remain in surplus till 2024. So the deficit in copper will start from 2025 onwards when the EV story will become big. Till that time, copper price, in the medium-term perspective, longer-term perspective, I would say, looks to be kind of having run its course. So prices yet could remain very supported because dollar is weak because of the supply bottleneck in China. But over the coming couple of months, once these supply bottlenecks ease, I think the copper prices would show a tendency to get back to more affordable levels for the consumer. Now, in case of aluminum, again, it's a similar story, electricity shortage story, but this story is here to last for a couple of more months at least. And even if the smelter starts to ramp up from end of September, they would take a couple of months to come up to the full capacity in China. So at least aluminum shortage is here to persist for a couple of more months. And sea congestion, as I get from the sources and my friends who specialize in the freight market, is that sea congestion is likely to continue till early 2022. So freight is going to stay high, and therefore aluminum arrivals into US will continue to remain strained. And looking at zinc, zinc is not a rosy story at the moment because the Chinese property investments are slowing down and China wants to keep them reined in completely. The only the bright star can be US infrastructure spending if at all that bill is passed, but it looks like there's a lot of debate happening. So it may not be as liberal as Biden wanted it to be. So that can be the only shining star. The inventory in Asia is plentiful. The premiums are soft. US premiums are multi-year high for the logistical hurdle reasons. But overall global picture, zinc is very well supplied, and there are not too many supply bottleneck problems. Lead, automotive slowdown is clearly slowing down. Automatic demand, automatic output is clearly slowing down. It's likely to extend into 2022. There's huge surplus in Asia. So much of surplus that India exported heavily in last 2 months because the international prices are so good that domestic prices are so suppressed. The only place where there's a deficit in the US, so metal is flowing into that region. It could take time because of logistical hurdles, but globally, supplies are more than demand. The last piece is nickel. Last deficit in China because of slower imports from Indonesia, again a temporary phenomenon. But if you look at the bigger picture, the stainless steel prices, which generally becomes the backdrop of nickel price rallies, they are falling in China. And that means that the demand is slowing, the construction is slowing. There has been demand for nickel for EV batteries as well, but yet, as a percentage of the overall demand, EV demand is still quite small. So I wouldn't really argue too much in favor of that being a bullish story. In case of tin, it's a Malaysian lockdown, the only story which has exhibited the shortages. The demand from the electronic sector is slowing because we are buying less of gadgets now. The global deficit is yet to persist for some time. Certain prices could come down, but it could remain elevated for most of the next year, most of this year. Sorry. That's what I had, and I just wanted to let you know that I have this app called Metal Intelligence Center, which is available in Google Play Store and App Store. So you can download, and we provide a lot of information, insights about the metal market.
Thank you.
On the app.
Thank you, Sandeep, for very, very interesting and insightful presentation where you brought so many different dimensions, including the logistics issue. Whoever would have thought, say, 3 or 4 years ago, that 20 and 21 will face logistics issue, container shortage, etc. I think these are uncertainties which keep happening all the time, and then the market participants have to take cognizance of these uncertainties. Thank you very much. Very insightful, very interesting presentation. I'm sure I have a request to make to all the participants. Whoever has a question, please write your name and post your question in the chat box so that our experts will be able to respond to your questions as much as possible. Thank you again, Sandeep. Let me move to Jnanashekar. Jnana is somebody who tracks precious metals, is one of the best known technical analysts in our country. And Jnana, the floor is yours. What's your take on gold and silver? And if you're able to touch upon currency also, so much better. Please go ahead.
Thank you, sir. Thank you so much. As usual, thanks for inviting me. Really honored. IMC and MCX doing a wonderful job, of doing such sessions. So it's not just knowledge awareness. I think more than that, it's also, talking deeply about market factors like this, which is going to go a long way, because you get very broad outlooks elsewhere, but with this amount of deep information will help a lot in taking directional call on most of these commodities. So that's a fantastic thing, sir. So that really kudos to IMC and MCX for this. Precious metals, I think, is being largely tracked by most market participants. So talking about broad fundamentals is only going to be a waste of time. What we have to understand is that the narrative at this point in time and going forward, what is the possible direction for the market? That's what I'll be concentrating on. I have a very short presentation, but it was more metal focused, so I added also precious metals to it. So I'll kind of touch upon some of the important factors that at this point in time the market is digesting, and what to expect going forward, which could sort of give some direction ahead. So if you look at the recent volatility which you have seen in both metals and precious metals, and specifically the industrial metals, it's basically the China's announcement that they will start coming up with their reserves, which they have across the board. They have for all commodities. So metals specifically, they wanted to sort of quell the volatility and also bring down the inflationary impact. So they started selling their reserves, but apparently it was not that great. I mean, the numbers that are coming out and what they've sold is not that great. So the market now is very clear that though China wants to do this, it's more like a cosmetic thing they're trying to do to manage prices. But genuinely, there is a demand supply problem. Demand continues to rise and supply continues to falter. As we speak, there are so many issues that are going on with mines across the world. Many mines in South America are having labor issues, and deficits continue to build up. And some of the long-term forecasts that we've had for metals is mind-boggling, because especially for copper and some of the important demand-centric commodities like copper, nickel, zinc, which are all heavily going to be dependent on the EV and the progressive sort of industries. I think the larger picture is that it is going to keep rising gradually, even though you might have some short-term price moves. There could be some pressure and the dollar could strengthen. So there are many factors that could have some short-term impact, but the broader long-term impact is that the supply-demand fundamentals alone are going to take metal prices much higher from where we are right now. Simply because most of these metals have been languishing over the last 10 years. If you look at the prices, and it just did not provide any kind of encouragement for mining companies to increase capacities, and you cannot increase capacities overnight because of a lot of environmental concerns and permissions. That's a big challenge to suddenly increase capacities in most of these metals. So that's basically what is driving metal prices, and I think will continue to drive metal prices going forward. But having said that, there are many negative factors also in play, which could have an impact. Of course, China's move to curb prices is very important, because if they feel, every time when they see prices rising, they could come and do this even going forward. But there's one thing very clear, if they continue doing this, then they need to keep replenishing these stocks as well. So as much as they come and sell the reserves, they will have to keep buying also simultaneously to keep the reserves, the reserve sort of kitty higher. So that is a double-edged sword. So that one needs to keep watching very closely. And then the Fed's tapering, it's been talked about a lot. My own personal sense is it could happen very soon. Because the inflationary impact is going to be phenomenal. The kind of package they're talking about, and the kind of money they've printed so far, and the way asset prices are rising, and unidirectional, one-directional stock market move that we're seeing is all extremely dangerous. There could be one trigger that could bring it all down, and I think the markets are waiting for that. And possibly the September meeting, there could be some announcements on this tapering. Because of the Delta variant, I think it got postponed. Otherwise, it would have already started. So that pressure is going to be there across the board on metals and precious metals. Though we'll be seeing, prices sort of moving up and down, being volatile in a range for some time. But definitely by the end of December, there is going to be a very strong impact of this tapering, and that in turn having a strong impact on the dollar. The dollar will start strengthening, as the tapering starts, and many of the carry trades that have happened. When I talk about carry trade, basically we have to understand that the dollar, which is a low interest rate currency, you can easily borrow in dollars and then put it in assets which are just rising right now, like equities, commodities, currencies. So when that happens and when the tapering is announced, then all these trades will start getting reversed. If not all, I think some portion of it, or a major portion of it, will start getting reversed. So which means that you have to, whatever dollar was used will have to come back. So there'll be a lot of dollar buying that will happen. So my feeling is that the last quarter of this year, I think that's a potential for dollar strengthening, primarily because the tapering should start, and a wave of dollar buying will happen, and treasury yields will increase. So and that's going to have a negative impact on most metals and basically precious metals, because it's inversely correlated with the dollar. So certainly we're going to see precious metal falter a lot in the last quarter. But having said that, at this point in time, with the enthusiasm the market has on tapering announcement that came, we should see some bit of momentum continue from where it is right now. We possibly revisiting 1850 levels, 1830, 40. That's going to be a very critical resistance for the market. There's going to be a huge amount of outflows, of ETFs and gold investments. Right now, safe haven demand is helping to a great extent, but I think it will fizzle out going forward. And I had an interesting question from one of the participants, which made me think, how much cryptocurrencies are also playing a huge role in precious metals. Basically, we have to understand that, if you compare gold and cryptocurrency, in very simple terms, gold is something where the supply can increase or continues to increase to some extent, whereas a crypto asset, the supply is locked. You cannot increase the supply beyond a certain limit. And the custodial cost of gold also is quite high compared to the custodial cost of Bitcoin. So these are the two important factors. And the third one being, the gold is still in the hands of central banks. So central banks could, sort of, I don't say manipulate, but then they control prices to a great extent. But still, Bitcoin is not. So all this are very attractive to investors, and already we have seen, in this year's, if you look at the WGC gold demand figures, a lot has come down as far as investment demand is concerned, largely thanks to Bitcoin as a competing asset to gold. So that's a threat for gold even going forward, because of this primary reason that supplies can increase in gold, whereas supplies cannot increase in Bitcoin. So this is the basic difference which will keep supporting investors moving towards crypto assets. So the larger direction for gold in near term is bullish, but it could have a lot of headwinds. There'll be a lot of challenges going forward. And potentially in the last quarter, there's a good chance that we will be revisiting the recent lows of 1,600 or even lower than that. Not just giving a price direction, but also a price outlook or a range where it could sort of come and find a lot of support. But we are headed there. Now, as far as silver is concerned, we're noticing that I'm taking you straight to the silver screen just to sort of give you an idea. There's some interesting numbers there, since it's also an industrial commodity. It's not just purely a precious commodity. And though it tracks gold largely, there's 50 to even 60% of industrial usage. So as we see industrial demand increasing, and as we see the other industrial metals doing well, it hasn't largely rubbed off on silver so far. But if you look at the latest supply demand figures given by Silver Institute, supply is increasing to some extent, but then the demand is much, much higher. And compared to gold, I think the potential for silver to increase is always there. And thanks to the ratio, also the gold silver ratio is favoring silver prices in a big way. So as an investment, certainly silver would sort of, in terms of allocation, would certainly be much higher than gold because of its potential to appreciate compared to gold, which is very clear now. Looking at the way prices are now behaving, I think silver is much more attractive and continues to gain both from the industrial side as well as the precious side. And of course, the dollar will continue to sort of determine direction for silver as well. But there's a lot of interest in silver that is seen from the investment side, and it will be continue to be seen. And the best part is we're also going to have a silver ETF in India. India has not had a silver ETF so far, and that should give a major fillip to the domestic markets. This is a demand which the domestic market has been having for a very long time. And the contention was that since it's an industrial metal, they didn't want any speculative activity so that it hurts the industrial demand side. But I think now there's some sense there, and I think they very clearly realize that it's an investment asset primarily. And of course, it does play a big role in industrial in the area, but then it is largely correlated with international prices, and therefore it will move in tandem with international prices only. And domestically, nothing can happen. If a set of speculators try to corner it. So if you look at silver and gold together, both are having good potential in the short term, but I'll be very cautious. Like I said, for gold also, I mean, just like gold, for silver also, we are going to see some really weak moves in the last quarter of 2021, primarily because of the dollar strength. So, these two metals are going to see some volatile moves, like Chandrasekhar sir had very clearly put out about the VUCA slide. It's going to play out now in the next 3 months. You will see both side movement. Now that you're seeing some strength, it will turn out to be so weak going forward. So, one needs to be careful as an investor, especially when you're taking bets on precious metal, that you need to be ready to flow with the market as and when factors evolve, and not just hold on to any long-term view and not changing your view from time to time. You have to be shameless as a trader to keep changing. If you hold on to your views, then you had it as far as precious metals is concerned. So I work with many investors, and this is the main problem with most of them. They're not savvy enough to turn with the market. You take a view and you hold on to it and hope that it will come in your favor at some point in time. That's the dangerous thing to do in these markets. I'll also touch upon the dollar. I think my own sense as far as the dollar is concerned is that this tapering is going to strengthen the dollar globally. But in India, it's going to be slightly different, because the kind of inflows that India is seeing is phenomenal. Even at this point in time, as we stand, the equity inflows are at this point in time at a record. Now, leave that alone. Now you have corporates and companies taking stake. For example, Reliance is now talking about a JV, or already talking at a very, very serious stage with Saudi Aramco. So we're talking about something like a $25 billion inflow that's coming in for the state. But a $25 billion inflow is not something which comes in every other day. It's a phenomenal inflow, and that could change the equation for the currency in a big way. It's not just Reliance. So many IPOs are lined up. So much of inflows are already hitting the market. And with the growth potential that India is talking about, and the way COVID has impacted India compared to other countries in a larger context, yes, they've got affected. But if you look at the US, Europe, and India, I think there's a big difference. And because of that, this growth story is playing out, and so much of investments are coming in from different parts of the world. If you look at Europe, now in Europe, if you keep your money in your bank, you have to pay interest to the bank. So it's negative interest rates there. So what would the investor there do? They're looking for lucrative destinations, and India comes to the top. And no one these days trusts China. So so they're looking at alternatives, and India comes first. So that's why we're seeing unrelenting moves in stock markets, because so much of inflows have come in, and I think that will keep the pressure in dollar rupee. The RBI though will continue to keep intervening from time to time. This is what will happen. We've seen dollar rupee hovering around 74, and suddenly it crashed to 1 rupee in just one day because of a huge inflow that hit the market. So time to time there's going to be huge inflows. My own sense is it will be in a larger range of 72 to 74. But the dollar rupee will be different here, and the global dollar will be different. So it's going to decorrelate with the global dollar for some time. And I think with that, I'll hand over the floor back to you.
Right. Thank you, Jnana, for this very, very interesting and thought-provoking presentation. Thank you very much. The word of caution from you is extremely important. Yes, don't have a fixed notion about how markets are going to move. Make trend your friend, as they say in market parlance, and therefore that's extremely important. Thank you very much. I'll now invite Rashmi for her presentation from MCX. Rashmi, the floor is yours.
Thank you. Thank you very much. I'll just quickly share my presentation and right. So thank you, Sir Chandrasekhar, Sandeep, and Gyanashekhar for all this wonderful insight that you gave everyone, from a global perspective. What I really want to, quickly run through is that with the changes that have happened in the MCX contracts over the last couple of years, there are certain domestic fundamentals, or I would say that, the trading pattern on MCX has changed to some extent. There are domestic, issues, domestic numbers that now impact the MCX price. And hence, right in the beginning, when Chandrasekhar sir said that it's important that you understand, that what are the fundamentals that impact price before you actually get into these markets and, take a more informed decision. The fact that, the contracts changed over the last couple of years have become a more India-centric or an India price benchmark. A few of the factors that come into play, when you are using the MCX contracts, whether you're trading, whether you're using for risk management, for whatever purposes, it's a good idea to keep a handle on that. What are these few factors that you should keep in mind before you begin or you take a position on MCX? So this is going to be a bit of a guide for you to understand that what now also influences the prices over and above what the three experts shared with you from a global perspective. So 2 years ago, we changed our contracts from cash settle contracts to delivery based. We used to have cash settle contracts which used to settle on the LME CSP number. But from a regulatory direction in 2018, we converted all our 5 base metal contracts from cash settle to delivery based from March 2019 onwards in a phased fashion. I think a very important factor that really helped us to do this in an easier or far easier fashion was the introduction of GST. So, that kind of, with doing away of the VAT and the intrastate taxation structure, it became far easier for us to have this conversion. Now, once we did this conversion, the price then moved from becoming a cash, where we were a simple mirror of the LME numbers in INR terms. I mean, whatever the differences were essentially because of the currency factors. We became, more of an India price benchmark, and that was what SEBI really wanted, that we have our contracts which actually reflect, an India price benchmark, and the price then became an ex-warehouse price. So wherever we have the delivery centers, the primary delivery center, wherever we have the warehouse, so the price moved to becoming an ex-warehouse price. So everything, every expense that you would have, bringing metal to the exchange warehouse, all of that, including except GST, is what today forms the MCX price. And hence, along with what you're looking at, the international factors, what the experts explained in terms of US, in terms of China, in terms of container movement, in terms of what really impacts commodities from a demand supply perspective, there are a few domestic factors or some factors that play on MCX also, which have an impact on the MCX prices. So one is that it's important to keep an eye on, domestically what the demand supply is. We have these numbers for FY 2021, which we have basically picked up from the Ministry of Finance. So what's been the production, what's been the import, what is the supply coming in, what's the total consumption in India. So while today we are a very small player in the overall global, metals industry, when you are using or when you are trading the MCX numbers, it's important to have a handle of what's really happening domestically also from the demand supply perspective. So this is how, this is just a quick structure for you. That what's the domestic demand supply in the FY 2021. Now, as far as MCX is concerned, you really need to keep an eye on open interest. You need to keep an eye on the volumes also. When we converted our contracts from the cash settle contracts to delivery based, immediately we did see a drop in volumes. We did see some drop. But for that matter, in some of the metals, we saw a significant amount of drop in the open interest also. That's because people took time to kind of to figure out what I would now call the new normal, which is no more a reflection, 100% reflection of the London Metal Exchange prices, but an ex-India warehouse price. So wherever the primary delivery center is, that's what your ex-warehouse price is going to be. So there was a drop, and I think when as more and more people from physical market started getting onto the bandwagon of deliveries, of understanding how this new pricing really works, we went back to seeing better volumes, to seeing better open interest. And then over a period of time, we also took certain informed decisions in terms of having spreading our footprint, in terms of creating more warehouses across India. For that matter, in October, we'll be having some additional warehouses coming in certain other parts of the country. All of this together, I think, has had significant impact on the open interest of certain metals. I mean, I would specifically here want to point out, say, for example, aluminium. Aluminium till before March 2021, we had only one delivery center, which was in Maharashtra. And a lot of feedback from the market then told us that it's a good idea to look at Raipur, to make that as a primary delivery center and continue to have Maharashtra as a additional delivery center. So we did a lot of market search, understanding, what we realized that with East being the hub of aluminium production, a lot of metal flows to Chhattisgarh, to Raipur, the chain breaks there, and then the entire distribution happens to the rest of the India from there. And that, that move actually turned out to be fairly beneficial to the open interest that was existing on the exchange. It just added, and also had a fair amount of deliveries coming in and exiting, okay, because some of the larger companies were anyway having their establishments already existing in Raipur. So where the warehouse delivery locations are moving, it's very important to keep an idea on, to keep constantly in touch with where exchange is now opening additional warehouses, whether it's moving its current warehouse from the additional and it's moving to some other state to make it primary. All of this today has a significant impact on the prices that you would see on the exchange. Now, when we talk about warehouse, it's also important to know that the stocks today that are there on MCX play a very, very significant role from a pricing perspective. On MCX, on our website, on a daily basis, we update the stock numbers. So you get a summary of stocks on a daily basis. You get to see that what is the total amount of stock lying in each of the warehouses. So for aluminium, like I told you, we have our primary delivery center in Raipur, and then we have in Maharashtra. For lead, we have in Chennai, which is a primary delivery center, and then Maharashtra is a additional delivery center. For zinc, lead, and nickel, our warehouses are in Maharashtra. And within Maharashtra in Thane, the entire, it's all spread out across 3 to 4 places in Guwahati, in Panvel, in Raigad. So we have 4 warehouses that are spread across these areas as far as Thane is concerned. So it's important to have a handle on, how the stock movement is there on MCX, how much of stock is coming in, how much of stock is exiting, because at the end of the day, this is what is going to ultimately have an impact on prices. You would also, it's important for us to tell you that the last 5 days of the contract month on the exchange is what we call as a staggered delivery period, where the entire delivery happens. So the people who have intention for whether for picking up the delivery or for depositing metal, essentially the settlement of the entire cycle of delivery happens in the last 5 days. So you will often see that there is significant, maybe not significant, but often there's a breakdown in the correlation between LME and MCX to a large extent in these last 5 days, because there's a lot of movement in stocks. If there's a quantity of stock coming in a certain metal, there is bound to be an impact, on the prices. If there's a significant amount of stock which is moving out of the exchange, there's bound to be an impact on prices. And also you have to keep in mind that we are in India centric, right? So every stock that's coming in or going out is more to do with what's really happening in India. We're not an LME where, there's a global trade that's really happening. Plus, like I said, that India is still a fairly small player as far as the base metal is concerned from a consumption perspective. So it's important to keep your eye very, very clearly open in how stock from the M6 warehouses is coming and going, because a very common and regular query that we get is that LME has moved by an X percentage, but we did not see that impact on the M6 prices. And like I said, it's important that you keep an eye in terms of how the stocks are moving on M6. Here again, I would want to give you the example of aluminium. Now, if you see this is 30th June, where the quantity of stock was around 6,176. So to see from May, it's almost a threefold jump in June, and then it's come down 50% in July. And I think if I were not mistaken, today what I saw was about 1,200 tons of stock which is lying on the exchange floor. So, this constant churning is bound to have an impact on prices, and hence you will often see that there is a snap in the very high correlations that existed with LME. So international factors, which were explained, by our guests, by the experts, absolutely have an impact as far as the prices is concerned. But today, along with that, it's important that you keep an eye on the numbers and the way they are moving, especially the stock numbers that are moving on in sales. Another very important, or I think a very significant development that we had seen was last year, when we had peak lockdown on MCX in India, somewhere between the end of March to say July. We saw maximum amount of inventory that came into the exchange warehouses, which suddenly had, we saw that prices on the exchange were fairly depressed. There were days when LME prices went up, but we couldn't catch up to that extent. Purely because a lot of the shipment or a lot of the inventory lying on ports, a lot of the inventory lying in warehouses or in factories, which because of the lockdown, there was no movement, and as long as it was an LME brand, found its way to the M6 warehouses. So we saw a lot of stocks coming to the warehouse during that time. So, while I don't really have this correlation, which also saw a break in the correlations with the LME prices. So hence, it's important to keep in mind that today MCX is being looked at from the physical market as a delivery of last resort, when the prices are more attractive than the way vis-a-vis the open market, or as far as import parity is concerned, people buyers come and pick the stocks from here. Also, there would be a fair amount of people who are looking at these stocks from an investment perspective. So, if the spreads are very attractive, then, if anybody from the institution side or individual HNIs who are very commodity agnostic and think that the spreads are very attractive by the end of the year, if they're able to get a return of anything which is about cutting down their expenses, which is anything about what they will get from the bank, they're more than happy to invest and have the metal being stored in the warehouse on a continuous basis. Metal being a non-perishable item, and especially on MCX, there is really no expiry. It continuously you can keep the metal till the time you feel that you want to exit your positions. So there is so obviously you will have these kind of participants who will take advantage of how the spreads are moving. The other important area is, besides the stocks, is to keep a watch out on spreads, because stocks itself will have an impact on how the spreads on aluminum, copper, lead, will move. Like I told you, the last 5 days specifically are for delivery. So typically people start rolling over their positions about 2 to 3 days before the staggered delivery period starts, especially the ones who are either from the hedging perspective or the ones who are from trading or speculating segment. They start moving to the next month. and the last 4 to 5 days is only left for people who are actually seriously interested in deliveries. So then you'll see that prices don't move much. There is a snap in the correlation with LME, and you will see a lot of population or a lot of populating of open interest that starts coming in the next couple of months or the next 2 months contracts. Hence, you will also see when such when stocks are coming or exiting, or the last 5 days of calendar you will start seeing a movement in spreads, calendar spreads, and then people also take advantage of these calendar spreads to figure out their strategy in terms of how they want to play the. So important to figure out, if I were to sum up, that what is the demand supply overall that's happening. Important to see that how stocks are moving on MCX across all warehouses. We have, like I told you, a daily summary report that we come out with on the website, which gives you an idea that what is the stock lying in the warehouse. So you could have a look at it on a daily basis, and then how the spreads are moving, which will give you a perspective in terms of if you want to create a strategy, or if you want to just figure out that how spreads, how stocks will be impacting the calendar spreads. Calendar spreads, like I also told you, is used very well by people who are from the HNI or the investment community or the institutional community who want to do how what we call in our parlance pyaj badla. So these are some of the domestic or MCX centric factors that you need to keep in mind, along with what is happening internationally, as explained by the guest who spoke before me. The last 5 days, like I told you, will always there is always a lot more decrease in correlation with LME prices. So while LME, London Metal Exchange prices, continue to have their impact on MCX to some extent, there will be days when the correlation will break, will snap, will reduce, to the extent what the trading community on MCX expects, simply because of a lot of these factors that come into play. So every time when you're looking at on MCX to create a position, please keep an eye on all of these factors and then take an informed decision. Okay. So it's no more an LME into INR kind of a price movement. It's a lot to do with what's really happening domestically, what the domestic demand supply fundamental is. Like I told you, when I showed you the stock slide. Now June is when we had the chocker block with Aluminium. We had a lot of stock that came in. We started seeing an exit in July, and then gradually, like I told you, we're close to about 1100 in terms of stock which is lying currently in warehouses. Most of the stock came in warehouse. I also want to add here that all our warehouses, the price is at par, so there is no premium and discount. So whether you're delivering at Raipur, you're delivering in Chennai, you're delivering in Maharashtra, the prices are at par. So obviously the material will come where it's cheapest to deliver. That brings its own dynamics in terms of the pricing, okay? Because when everything is at par and there is no premium and discount, there is bound to be delivery only where it's most convenient and most cheapest to bring, okay? Which again will have its own impact as far as the MCX price is concerned. So from June to July, okay, and if you know that globally also there has been, we've heard right now the demand for aluminum has gone up. The aluminum stocks in India have performed very well from whatever I have been seeing and reading about it. And we saw an huge quantity of stock actually move out of MCX. So we were halved by July, and then we've actually less than half as of now, if you were to look at the current stocks on MCX and aluminum. Very similar story we saw in nickel. If you see from May to June, a little drop, and then again a drop in July. Now it's quite possible that locally there is more demand for this metal. Maybe MCX is working out to be cheaper to buy currently. I mean, those could be various factors. Maybe because probably the steel industry are doing this phenomenally well. Demand for nickel could be high. MCX is giving up better prices, so let's just pick it up. So please keep in mind that along with whatever is happening globally, all of these factors are going to be a very, very important area for all of you to keep a track of, to get a better understanding of how MCX prices are moving. I gave you an idea on the delivery centers already. So we have a primary delivery center for aluminium in Raipur, for lead in Chennai, and for copper, nickel, and zinc in Thane. For additional delivery centers, we already have Thane for aluminium and Thane again for lead. But from October onwards, these are the delivery centers, additional delivery centers that we are coming up with. So we have NCR for lead, we have nickel for Chennai, and we have Kolkata for zinc. Now, what the additional centers really effectively, what is that impact going to bring about in prices? It's too early for us to say, but I'm sure that, you know, if somebody finds NCR to be cheapest to deliver lead, or, you know, somebody, if the demand for lead picks up and we think that this warehouse is where a lot of delivery is lying, they'll come and pick it up from there. So you know, with we expanding our global footprint, there is bound to again bring in fresh dynamics as far as the pricing on MCX is concerned for all of these base metals. And hence, please keep an eye on all the changes that are happening on the MCX contract front for you to get a better understanding or perspective in how the MCX prices are going to change because of the domestic reasons. So spreads I've already finished. The other thing that we have noticed, you know, because these contracts are about 2 years old, you know, we've also eventually learned. India has a lot of FTA or free trade agreements with, you know, various countries. So for example, a lot of copper that came into the MCX warehouses came from Japan. So if you have access to cheaper materials that will come into Japan in that 0.5% regime. And with Southeast Asian countries where you have South Korea and Malaysia, etc. This is zero duty regime. So if you have access to metal from any of these countries, you can get it to India shorts at a cheaper price. MCX is, you know, running it up. They will bring it cheaper and they will just dump it on the exchange because of, you know, the price arbitrage that they're able to get. Hence, a very important factor again that plays is that how are you able to get, or from where are you able to get access to it? So whatever is produced domestically, that's one thing. So if you're getting access to that, fine. You have access to domestic, to international importer or an actual consumer. You have access inventory or capital MCX. So from where you are importing, you know, and you're coming in with, you know, a lower duty regime, you're very well able to, you know, take advantage of the price on MCX. You know, you bring in huge quantities, dump it here, you know, you will suddenly see an impact in prices. So all of these factors gradually over the last 2 years have started building up and showing or reflecting itself in our prices. And hence, it's great if you could keep an eye, like I told you, on some of the earlier factors. Which other countries we are having an FTA with? What is the current duty regime for bringing metal from, say, Japan or from Southeast Asian countries, or from concentrators coming from Chile? So this gives you an idea. And if you're from the industry itself, and if you have access to cheaper material, then why not bring it here and, you know, take advantage of you know, if there is a better pricing available on MCX. So these are some of the local factors, or I would say MCX-centric factors, quote unquote, for you to keep in mind when you're actually using MCX numbers to trade, and be a little more informed in terms of, you know, what is going to impact the pricing here. Obviously, this has been very, very detailed, and in a very, very micro fashion put forward by all the guests. The international events will continue to have their impact, whether it's unemployment data, whether it's non-farm payroll, whether it's what Fed is deciding, whether what are the central bank policies, you know, what is the inventory lying on the global exchanges, or, you know, within the country, like, you know, Sandeep wonderfully explained to us that what's happening in China as far as lead is concerned, whether it's the whole supply side bottlenecks, all of this is bound to have an impact, you know, from an international perspective, because that's what is going to shape the price globally. You know, have an impact on, you know, on India. But we being today an India price benchmark, please do not keep your eye away from, you know, what are the local factors also that can have an impact on the MCX pricing, you know, today, vis-a-vis what used to happen 2 years ago when we were totally in line with, you know, how LME would change. So this is how, you know, the shape of things is today on MCX. vis-a-vis what it used to be 2 years. And whenever you decide to create a position on MCX, it cannot be just basis what you're seeing internationally or enemy. It's important to keep an eye on what's happening locally. How much of the imports are coming into the country, where they're coming from. What is the stock position on M6, how the stocks have moved in and out of, the M6 warehouses. Where are the warehouses, additional warehouses, or primary delivery centers if you want to shift them? Where is all of this, really coming from? And another important factor that I would like to add here is that we are now coming up, currently we accept only LME approved brands. We're now coming up with something as a brand empanelment process where we would want to start enrolling or empaneling Indian brands, which is something which we're doing for lead. And once that comes into play, because barring Hindustan Zinc producing primary lead, we have a very, very huge secondary lead market. Okay, so once that comes into play, then how things will, too early for us to say. But we have got phenomenal response from the market for this brand empowerment process. So how this will really shape up, going forward, and what kind of impact it will have prices going forward, is again something we need to really wait and watch and move forward. So with that, I'm just going to end my presentation. This is the last slide, which I want to just give you an idea in terms of what are the screen components today that form the MCX price. So you have the international price, premium, the RBI ref rate, the customs duty, and then finally, whatever is the landed cost, transportation, and whatever is the cost to run to the warehouse. So if I were to say, just look at, for example, say zinc, so 225.33 is a landed cost to warehouse. So all the kharcha to bring your material to Chennai, which is a primary delivery center, is what, to Thane, which is primary delivery center for zinc, is basically what your price component for MCX price today is. All of this, of course, is ex GST. GST is 18% only when deliveries will happen. So, with this last slide, in terms of to just give you an idea of what are the screen components of MCX prices, and you should keep all of these factors in mind because they're all dynamic and would all have an impact on the M6 prices if there are any changes that are happening, whether it's globally or locally. So with that, I'm going to end my presentation, and if there are any questions for all of us, we are open to it.
All right, thank you very much, Rashmi. Thank you for very interesting presentation, insightful. I think it's important that you talked about the Indian market, role of MCX, and price discovery in India. Primarily, in the last 5 days of the delivery period, there is a potential for the correlation to snap, which makes eminent sense. I think it's a very important message, in my view, for all the participants. We have actually exceeded our time, but I think I'm in no hurry to conclude this. Let's have a look at the chat box if there are questions. Let me see. Post your questions. Is there any impact of cryptocurrency? I think Gnanashekar has done it. He is responded. Somebody, we have 1 second. Let me move this. Please ask a question, check the feedback. Is there a commodity bubble building up like in 2009? Let me answer. Of course, if Sandeep or Jnana has a response, fine. But in my view, there is no commodity bubble as of now. It is simply that, like it happened in 2009 and 10, too much money, too much cheap money is chasing commodities and chasing all the asset classes for that matter. Therefore, at some stage, when this ultra accommodative monetary policy starts to reverse, then the market fundamentals of supply and demand will start to assert themselves. Therefore, I don't see this as a bubble building up. Number two, people are also talking about a commodity super cycle. I don't see any super cycle at all within the horizon. and therefore it's a phenomenon of the market that happens almost every 10 years that we have seen. Has COVID impacted the volume in trading? I'm not sure if Rashmi has a response to that question.
So, so Ankita, what I would like to add is that we did see some impact when peak lockdown was there last year, because one thing that really happened was that April 2020, the trading hours were curtailed, so we had to shut shop by 5 o'clock instead of we working till 11:30. So that was because of that number going down, in the sense we had an additional 8 to 9 hours of trading that was not happening. So we did see an impact of COVID coming in around then, till the time that this entire thing was restored. So yes, initially for a couple of months we did, but after that, it's been back to being what the usual volumes have been. So I don't think, barring that month, there has been any impact.
Very good, very good. There's another question. Any view on steel sector, including iron ore? I'm afraid we are not discussing steel and iron ore today. Maybe there'll be another opportunity for that. But let me say a correction is possible in the steel sector and steel prices. I won't be surprised if iron ore prices were to drop by 10% from the current levels in the next few months, primarily because of the China factor, where steel production is certainly slowing down. Anyway, I think we'll stop there. Any parting comments, Sandeep? You want to share something with the participants? I want to ask each one of the panelists. Audio, unmute.
So sorry, yeah. I think it's an interesting time where there's so much money chasing everything, and there was a housing bubble, there was an internet bubble in the past. Maybe bubble is not the right word to use, but we are saying everything is ballooning. Everything has a very high speculative premium, from equities to currencies and everything to bond markets. I mean, look at bond yields. US 10-year bond yields should not have been here. Inflation is being ignored, and so a lot is happening in the financial market. Financial market has become far bigger than the economy itself. So that's not a good development, because that, in a way, I mean, on a personal note, I would say that it takes people away from productive work to more financial market activities, which is not good. But in any case, I think at some point in time we would adjust ourselves to the new reality. But wherever we are, everything looks unsustainable. But I think everybody has this question: what would trigger normalization? Nobody is expecting a collapse because central banks are behind everything. But what would trigger a normalization? China has already slowed. US has started to slow. Europe has started to stagnate. Would 2022 be a normal year, a year where things would normalize back to the balance? I think most of the economists inside us would like to think of that.
Right, very true. I think the Wall Street guys will be very upset with your statement, your initial statement. But that's how it is. I call this. I don't know if I can use that term. There is a money market mafia. Okay. Pardon me for saying this, but anyway, that's okay. Thanks, but I think I agree. Jnana, any parting comments from your side?
I'd just like to add to that commodity volume. It's an interesting thing that in the last couple of years, I have this following in Money Control. The subscription page where a lot of investors come and subscribe to my views on precious metals and other commodities. So what I have noticed is there's a huge quantum jump in terms of investor interest.
Right.
So that should have actually resulted in higher volumes for the exchange. There's so many investors who traded in equities, made a lot of money there, just want to come and test waters here. So many of them have come recently, but with that equity mindset. So that's very dangerous, because coming with that mindset, where an intraday trading call goes wrong, you just put it in the closet and it'll keep growing going forward. So an intraday trading call that goes wrong becomes a long-term investment in equities. But that doesn't happen here. Most of these stories and narratives have a very short-term period, and one needs to keep moving with the market. So that's a very dangerous thing that I'm noticing among investors lately. Risk management becomes very, very important. Adhering to stop losses, adhering to trading, risk management is very, very important. Otherwise, you'll get burnt off and run away from this market forever.
Completely agree. Completely agree with you. Any parting comments, Rashmi, before we conclude?
Yes, so I just want to add.
You have to say?
I just want to add that as an exchange, as far as base metals is concerned, we've really evolved over the last 2 years. When we converted these contracts, watch out for us to kind of expand our footprint pan India. Where there will probably some more warehouses, more opportunities for people to actually look at deliveries, whether it's the larger industry or whether it's smaller guys who are looking for smaller tonnages, easy access hopefully to metal, because today what happens is that everybody says that your pricing is a little more Western centric because you just have your warehouses spread across the Western region of the country. So we are looking at spreading out, making if I could use a one India, one price kind of a attempt, probably it will take us about next 2 to 3 years to reach there. But yes, and hence more informed decisions in terms of what is happening domestically also will play a very, very important.
Yeah, thank you. I think with this we need to conclude, but there is just one question which we need to take. Let us tackle. The question is, commodity exchanges are supposed to offer hedge opportunities to actual users. However, they also encourage speculative tendencies which increases price artificially. I think with due respect, speculators or investors are an integral part of the market. They bring in liquidity. They help with the proper price discovery. If you have only actual producers of commodities and actual consumers of commodities, there won't be much of a trade because there'll be standoff. The speculators are people who have deeper knowledge about the dynamics of the market. They have risk appetite, and then they are willing to take trading positions, and that's what builds volumes on the exchange. That is what makes for proper price discovery. Therefore, don't let us not look down upon the role of the speculator or the investor. They certainly perform an economic function, but what is important is manipulation. There shall be no manipulation. There has to be genuine speculation in the market. There is no doubt at all. Number one. Number two, if you have hedgers in the market, and if the hedgers don't hedge in the market, they are actually speculating on prices. Therefore, hedging is not speculation. Not hedging is speculation. Is something I've been saying for last 20 years. So speculators have a role to play. They certainly perform a certain economic function. With this, I think we need to conclude. It's nearing 6 o'clock. I want to thank friend Sandeep Daga for excellent presentation. Thank you, Jnana, for sharing your thoughts and coming in at the last moment. And as always, Rashmi is a top class presenter, speaker, brings MCX's perspective so well. And I want to thank all the participants and for all the questions that they have posed and the responses that our panelists have given. I also want to thank Anita from IMC for organizing this and administratively supporting this event. With this, let us conclude this event. Good luck. God bless you all. Stay safe.
Thank you. Thank you, sir. Bye, Sandeep.
Thank you. Thank you, everyone.